All right, let's dive into some Dave Ramsey territory today.
Sounds good.
We're going deep on baby step 4.
Right.
Investing 15% of your income for retirement.
Okay.
We're going way beyond just the basics here.
Yeah.
We really want to break down the why behind that magic number and how hitting that 15% mark consistently can get you on the path to, well, a 7-figure nest egg.
That's right. We're going to assume that you already know Ramsey's baby steps.
Right.
So we're skipping over the 101 and jumping right into those advanced strategies.
So let's just address the elephant in the room. 15%, that sounds like a pretty big chunk of change.
Yeah.
What's the reasoning behind that specific number?
It's not just some random number.
Right.
Ramsey's 15% rule is based on a few things. First, it lets you keep making financial progress. You're not giving up your present life for the future.
Right.
But you're also not ignoring your long-term financial health.
Gotcha.
It's all about finding that sweet spot, where you're investing regularly but still taking care of your daily expenses and your other goals.
That makes sense. But some people might say that being more aggressive early on could lead to bigger gains, because of compounding. What do you think about that?
There's definitely something to be said for getting a head start with your investments.
Right.
Especially when you're younger. You have more time to let things grow.
Yeah.
Compounding is powerful, no doubt. The sooner you start, the more time your money has to grow exponentially.
Right.
But Ramsey's approach is more about getting those financial basics solid first.
Yeah.
He's all about getting rid of debt and building up that emergency fund before you jump into investing.
So it's kind of like building a strong base camp before you try to climb Mount Everest.
Exactly. You wouldn't start building the second floor of a house before you had a solid foundation, would you?
Right.
Same goes for your money.
Yeah.
Ramsey's baby steps, they give you that structure. Make sure you're not taking on too much risk while still building up your wealth for the long term.
All right, so let's say we've got that solid foundation in place, no more debt, emergency funds good to go. How do we actually calculate this 15%? It's got to be more than just grabbing a calculator, right?
Well, a calculator definitely helps.
Right.
But the math itself is pretty straightforward. Take your total household income and multiply it by 0.15.
Okay.
So let's say your household income is $60,000. That means you'd aim to invest about $9,000 a year.
Right.
Then you just divide that by 12.
Yeah.
And you get a monthly investment target of $750.
Okay. That seems pretty easy. But where exactly should that $750 be going every month? I know Ramsey has some thoughts about what kinds of investments are best.
He does. He really likes those employer-sponsored retirement plans.
Okay.
Like 401ks and 403bs. Mostly because of the possibility of getting matching contributions from your employer.
Yeah, the free money everyone talks about.
Exactly.
But some people argue that those matching contributions are just a way for companies to pay you less. What'd you say to that?
That's a good point. It's true that some companies might use those matching contributions as a way to negotiate a lower salary.
Right.
But it's still a huge perk that you shouldn't ignore.
Yeah.
It's basically free money that goes straight into your retirement savings.
Yeah.
It speeds up your progress toward your goals.
Right.
So even if your salary is a little bit lower, the long-term benefits of those matching contributions, especially with compounding, can make up for it.
So it's about playing the long game, not trying to win in the short term.
Exactly. You're thinking strategically about the future, not just focusing on what's happening right now.
All right, so we've got 401ks on our list. What other investment options fit in with Ramsey's approach?
Well, along with 401k, he's a big fan of individual retirement accounts. Those are IRAs. You've got two main types, Roth IRAs and traditional IRAs. They both have good points and bad points. Really understanding the details can help you decide which one is right for you.
All right, so let's dive into those details. What are the main differences between a Roth IRA and a traditional IRA? And how can our listeners figure out which one's a better fit for them?
With a Roth IRA, the money you put in is money you've already paid taxes on.
Okay.
But the great thing is that when you take money out in retirement, you don't have to pay taxes on it.
I see.
That can be a big advantage if you think you'll be in a higher tax bracket when you retire.
Right.
Now, with a traditional IRA, you might be able to deduct your contributions from your taxes now.
Okay.
But you'll owe taxes when you take the money out during retirement.
Gotcha.
This can be good if you're in a high tax bracket now, but think you'll be in a lower one when you retire.
So it's like a tax puzzle, trying to figure out which way will save you the most money in the long run.
Exactly. You have to think about your current financial situation.
Yeah.
What you think your income and tax bracket will be in the future. And then choose the type of IRA that works best with your long-term goals.
Makes sense. And don't forget about those contribution limits everyone's always talking about.
Right, good point.
Mm-hmm.
For 2024, the most you can contribute to either a Roth or traditional IRA is $6,500,
Okay.
or $7,500 if you're 50 or older.
Gotcha.
That's definitely something to keep in mind when you're planning how much to invest.
Okay, so we've got 401ks and IRAs on our investment menu. Now, what about the actual investments that should be going into these accounts? I know Ramsey has strong opinions about mutual funds.
He does. He's a big believer in the power of growth stock mutual funds for retirement.
Okay.
He thinks they offer the best potential for building wealth over the long term. Fits with his whole philosophy of steady growth and thinking ahead.
But why growth stock mutual funds specifically? Wouldn't it be safer to have a mix of different investments?
That's a common misconception. While diversification is definitely important. Ramsey's reason for focusing on growth stock mutual funds is because of how they've performed in the past. Over the long term, growth stocks have consistently done better than other types of investments.
Okay.
They give higher returns for investors. He sees them as the key to building wealth, especially for people who are saving for retirement.
So it's about investing in companies that are expected to grow faster than the rest of the market.
Exactly.
Yeah.
He even suggests a specific way to split your investments.
Okay. How's that?
25% in growth funds,
All right.
25% in growth and income funds,
Okay.
25% in aggressive growth funds, and 25% in international funds.
Now, these aggressive growth funds sound a little intense. What exactly are they and how risky are they?
Aggressive growth funds, they invest in companies that have a lot of potential for growth, but also come with higher risk.
Okay.
These companies are often in newer markets or industries that are changing things up.
Right.
Can lead to big gains, but also more ups and downs. They're not for everyone.
Yeah.
But for people who have more time to let their investments grow and who are comfortable with a little more risk,
Right.
they can be a good part of a well-rounded retirement portfolio.
So it's all about finding that right balance between risk and reward.
Exactly. And that's where the other parts of Ramsey's suggested investment mix come in.
Oh, okay.
The growth and income funds give you a bit more stability.
Yeah.
And the international funds diversify your investments across different global markets.
Gotcha.
That way, you're not putting all your eggs in one basket, so to speak.
So we've got a pretty good understanding of Ramsey's favorite investment types and the specific funds he recommends. But let's talk strategy. If someone's ready to start investing that 15%, where do they begin? What's the first step?
The very first thing is to make the most of any employer match you have in your 401k
Yeah.
or 403b.
Right.
It's basically free money, so take advantage of it.
Absolutely.
Once you've maxed out that match, if you can, put money into a Roth IRA up to the limit.
So it's like a financial ladder, prioritizing the options that give you the most immediate benefits.
Exactly. You're making your investment strategy as efficient as possible to get the most return and pay the least in taxes.
Gotcha.
After you've maxed out your Roth IRA contributions, you can go back to your 401k or think about a traditional IRA. It really depends on your situation and your goals.
All right, so we've got our investment roadmap all figured out, but let's be honest, choosing the right funds can be a little overwhelming. There are so many options out there. What are some tips for our listeners who might be feeling lost in the world of mutual funds?
There are a few key things to keep in mind when you're picking mutual funds. First, like we talked about, look for funds that have a good track record. At least 10 years of consistent returns. This shows you how the fund has done in different types of markets, not just when things were going up.
So we're looking for those steady performers, not the ones that just shoot up quickly.
Exactly. It's all about long-term growth, not following the latest trends. And another important thing is those fees, the expense ratios. You want to keep those as low as possible, ideally less than 1%. Otherwise, they'll eat into your returns over time.
Yeah, those fees can really sneak up on you. It's like they slowly chip away at your investment gains.
That's a great way to put it. You want to make the most of your returns, and keeping those fees low is a big part of that.
I know some people are comfortable doing their own research and picking their own investments, but for others, it can be a lot to handle. What about financial advisors? What role do they play in this?
I think for a lot of people, especially if you're new to investing or you have a complicated financial situation, a good financial advisor can be incredibly helpful.
Okay, so let's say someone decides to get some professional help. How do they find an advisor who's really going to look out for their best interests?
Look for an advisor who acts as a fiduciary. That means they are legally obligated to put your interests first, even before their own commissions or any incentives they might get from investment companies.
So it's like having a financial advocate on your side, someone who's in your corner and fighting for your financial well-being.
Exactly. They can help you create a personalized investment plan, guide you through those tough decisions, and provide ongoing support as your needs change.
Okay, so we've talked about choosing funds, fees, and getting help from advisors. But there's one more piece of the puzzle we need to discuss: diversification. It's a word you hear a lot in the investment world. But what does it actually mean, and why is it so important?
Diversification is all about not putting all your money into just one thing.
Right.
It means spreading your investments across different types of assets,
Okay.
like stocks, bonds, real estate, and maybe even some international investments.
Gotcha.
This helps to lower your overall risk.
Okay.
Think of it this way. If you put all your money into just one stock and that company goes bankrupt, you lose everything.
Yeah, that's not good.
But if you spread your investments out
Right.
across different things, you're less likely to lose everything if one investment does poorly.
So it's like creating a safety net for your portfolio, spreading the risk and making things a little smoother.
That's a great way to put it. Diversification is one of the best ways to manage risk and protect your money.
Now, I know Ramsey really focuses on those growth stock mutual funds, but does he ever talk about diversification?
He does.
Hmm.
While he believes in the growth potential of stocks, he also recommends diversifying across different types of growth funds,
Like what?
like growth, growth in income, aggressive growth, and international, like we talked about before.
Right.
This helps spread your risk across different parts of the economy and even different countries.
Okay.
So you're not too dependent on any one area doing well.
So it's like creating a balanced environment in your portfolio.
Exactly. It's about finding that sweet spot between maximizing growth and minimizing risk.
All right, and I think we've covered just about everything there is to know about Dave Ramsey's baby step 4.
Yeah, we have.
We've talked about why investing 15% is important, looked at the different types of investments, and even got into the details of choosing funds and the importance of diversification and getting advice from professionals.
This has been a great discussion.
Before we wrap up this part of our deep dive, let's give our listeners some key takeaways and things they can do to start their own retirement investing journey.
Absolutely. Welcome back to the deep dive.
So we just laid the groundwork for understanding Dave Ramsey's 15% rule for retirement investing.
Yeah, we did.
But what about folks out there who maybe they don't have access to a traditional employer-sponsored 401k?
Right.
Does that mean they're out of luck when it comes to investing for retirement?
Not at all. While 401ks are great, especially with that employer match, they're not the only option.
Okay, good.
Like we mentioned earlier, IRAs are a great alternative, both Roth and traditional.
Right.
And if you're self-employed, there's the solo 401k. You're both the employer and the employee, so you can contribute from both sides, so to speak.
The solo 401k, that sounds pretty cool.
Yeah.
It's like you've got double the savings power.
Exactly. It's a really powerful tool for self-employed folks to supercharge their retirement savings.
But what about the whole affordability thing? I think a lot of people hear invest 15% and they just think, no way, I can't do that.
Yeah.
What advice would you give to someone who's maybe struggling to make ends meet,
Right.
let alone invest a big chunk of their income?
That's a valid concern. It's important to remember that Ramsey's baby steps are meant to be followed in order. Baby step 4, that's where the 15% rule comes in. It comes after you've tackled your debt and you've built up that emergency fund.
Right.
So if you're still dealing with high interest debt, that's got to be your priority. Once you've got those things handled, then you can focus on really ramping up those retirement contributions.
So it's like you got to build a stable base before you start constructing a skyscraper.
Exactly. You want to make sure you're financially secure in the present while you're setting yourself up for a great future.
Okay, so let's say someone's got no debt, a healthy emergency fund, and they're ready to start investing, but maybe that 15% still seems like a big leap. Where would you suggest they start?
The key is to start small and just keep at it. Even if you can only invest 5% or 10% right now, that's a fantastic start. The most important thing is to get into that habit of saving and investing regularly.
So it's not about making some grand gesture, it's about taking those small, consistent steps.
That's it. It's a marathon, not a sprint, right? And remember, as your income grows or your situation improves, you can always bump up those contributions little by little.
It's like building those financial muscles gradually.
Exactly. Just like working out, consistency is key. The more you invest, the stronger your financial foundation gets.
Speaking of building a strong foundation, one question that pops up a lot is whether people should prioritize paying off their mortgage before they start investing. What's Ramsey's take on that?
Ramsey is all about getting completely debt-free, and that includes your mortgage. But in his baby steps, paying off the mortgage actually comes after investing 15% for retirement.
So he sees investing as a higher priority than being mortgage-free. That might surprise some people.
It might seem counterintuitive, but his reasoning is that you can potentially earn more in the market than you're paying in interest on your mortgage.
Okay.
Historically, the stock market has done better than the average mortgage interest rate.
Hmm.
So over time, you could build more wealth by investing that money instead of using it to pay off your mortgage faster.
So it's about using the power of the market to potentially outpace the cost of your debt.
Exactly. But of course, this approach depends on how much risk you're comfortable with and what your financial goals are. Some people just feel better knowing their mortgage is paid off, even if it means they might miss out on some investment gains. It's about what works best for you.
That's a great point. There's no one right answer when it comes to personal finance. You've got to tailor your strategy to your own situation and what's important to you.
Absolutely. That's why really understanding these concepts is so important.
Right.
It allows you to make good decisions that fit with your values and what you want for the future.
Speaking of making good decisions, let's go back to the idea of automation. We talked about it briefly before, but I think it's worth digging into a bit more, especially for people who are new to investing.
I agree. Automation is one of the best tools you have when it comes to managing your money. It takes the thinking and the temptation out of saving and investing.
Right.
By setting up automatic transfers from your checking account to your investment accounts, you're basically putting your financial goals on autopilot.
It's like setting up a system that works for you, even when you're not actively thinking about it.
Exactly. It's about removing those mental roadblocks and making investing a seamless part of your routine.
And the best part is, most banks and investment companies make it super easy to set up these automatic transfers. You can literally set it and forget it, knowing that your money is steadily growing in the background.
It's truly one of the easiest and most effective ways to build wealth over time.
All right, so we've addressed some of the common worries, talked about the power of automation, and emphasized finding a strategy that works for your individual situation. Before we move on, let's revisit one of the most fascinating concepts in investing: the magic of compounding.
Ah, compounding. The gift that keeps on giving. That silent force that can turn those small, consistent investments into a serious nest egg over time.
I think a lot of people hear compound interest and their eyes kind of glaze over. It can seem like a complicated, abstract idea. How would you explain it in a way that's easy to understand and maybe even, dare I say, exciting?
Okay, imagine you plant a tiny seed in the ground.
All right.
At first, you don't see much happening at all.
Right.
But over time, that seed starts to sprout, putting roots down into the soil and pushing a little stem up towards the sun. As the years go by, that tiny seed turns into a strong, tall tree with branches reaching up to the sky and a thick, sturdy trunk.
That's a beautiful analogy. So I'm guessing the seed represents our initial investment, and the tree is how that investment grows over time, thanks to compounding.
Exactly. With compound interest, you earn interest not only on the money you put in, but also on the interest you've already earned. It's like earning interest on your interest. It creates a snowball effect that just makes your money grow faster and faster.
So the longer you invest, the bigger that snowball gets, rolling downhill and picking up speed as it goes.
That's the magic of it. And to bring it back to Dave Ramsey's 15% rule, imagine investing that amount consistently for 30 or 40 years. The power of compounding can turn what seem like manageable contributions into a life-changing amount of money by the time you retire.
It's a good reminder that when it comes to investing, time is your biggest ally. The earlier you start, the more time you have to let that compounding magic work its wonders.
Couldn't agree more. And it's never too late to start,
Right.
but the sooner the better. Even if you're starting a bit later in life, consistency and discipline can still make a huge difference.
Absolutely. So let's go back to that example we used earlier. If someone invests $750 a month, starting at age 30, and they earn an average of 10% per year, they could have over $2.6 million by the time they're 65. That's a pretty amazing example of compounding in action, don't you think?
It's pretty mind-blowing when you think about it.
Yeah.
It really highlights why it's so important to think long-term and trust the process. Even if you don't see huge gains right away, compounding is working behind the scenes, quietly building your wealth year after year.
It reminds us that patience and sticking with it are key when it comes to investing.
Absolutely. It's not about getting rich quick. It's about building a solid foundation for a secure and prosperous future.
So we've looked at the power of compounding, talked about some common concerns, and stressed the importance of starting small and being consistent. What other insights can we take away from our deep dive into Ramsey's baby step 4?
One crucial aspect we haven't really touched on is the psychological side of investing. It's not just about the numbers and the spreadsheets. It's about your mindset and your emotions, too.
That's a great point. Investing can feel like an emotional roller coaster sometimes.
It can.
The market goes up, it goes down, and it's easy to get caught up in all of that. How can we develop a mindset that helps us stay focused on those long-term goals, even when the market is being unpredictable?
One of the most important things is to remember that investing is a long game. Don't get distracted by what's happening in the market from day to day or week to week.
Right.
Instead, focus on your overall investment strategy and where you want to be in the long run.
So it's about tuning out the noise and focusing on the signal.
Exactly.
Fair
It's
enough.
easy to get caught up in the hype or the panic that often surrounds the market. But remember, you're not investing for just the next month or even the next year. You're investing for the next 30, 40, maybe even 50 years.
Yeah, it's a marathon, not a sprint.
Exactly. And just like running a marathon, you need to pace yourself, stay hydrated, and avoid getting sidetracked by distractions.
I like that analogy. So how can we build up that mental toughness, that resilience that will let us stay on track even when the market gets a little rocky?
One helpful strategy is to educate yourself about investing. The more you understand about how the market works, the less intimidating it becomes. There's tons of information out there. Books, articles, podcasts, online courses, you name it.
So the more you know about investing, the more power you have.
Absolutely. The more you know, the more confident you'll be in making good decisions. And don't be afraid to ask for help from trusted professionals, like financial advisors or certified financial planners. They can give you personalized advice and support, helping you navigate the market and develop a sound investment plan.
Yeah, sometimes having that expert perspective can be really valuable, especially if you're feeling lost or unsure.
Exactly. And remember, investing doesn't have to be a solo mission. There are communities of investors out there who can offer support, share their experiences, and encourage each other.
So it's about finding your people, connecting with others who are on a similar path, and learning from each other's successes and mistakes.
Exactly. Investing can feel isolating sometimes, especially when the market is volatile. But connecting with others who share your goals and dreams can create a sense of community and support.
Okay, so we've talked about the psychological aspects of investing, emphasized the importance of education and getting guidance from experts, and even touched on the value of finding a supportive community. Before we head to the final part of our deep dive, let's just take a moment to reflect on what we've learned so far.
I think one of the key takeaways from our look at Ramsey's Baby Step 4 is that investing doesn't have to be super complicated or scary. With a solid plan, some knowledge, and a good amount of patience, anyone can build wealth over time.
That's a great point. It's about giving people the tools and the confidence to take charge of their financial future and create a path towards financial freedom.
Exactly. It's about shifting your mindset from scarcity to abundance, from fear to confidence, from feeling overwhelmed to feeling empowered.
All right, so let's move on to the last part of our deep dive. We'll explore some practical tips for choosing the right investments, really dig into the importance of diversification, and leave our listeners with some actionable steps they can take to start building their own path to financial security.
Sounds like a plan.
Welcome back to the final part of our deep dive into Dave Ramsey's Baby Step 4. We've really unpacked this whole 15% investment thing.
Yeah, we have.
But before we wrap up,
Okay.
let's talk about the actual investments themselves.
Right.
It's all well and good to say invest in mutual funds.
Yeah.
But with so many options out there,
So many.
how do you actually choose the right ones?
That's where it can get a little tricky. Remember how Ramsey's all about those growth stock mutual funds?
Uh-huh.
Well, there's a strategy for picking those too.
Okay, spill the beans. What's the secret sauce?
First, you're looking for consistency.
Okay.
Ramsey recommends going for funds with a proven track record.
Okay.
At least 10 years of solid returns.
Okay.
You want to see how they've performed through different market conditions,
Yeah.
not just a quick burst of growth.
So it's about finding those steady performer,
Yeah.
the tortoises rather than the hares.
Exactly. It's about long-term growth,
Mm-hmm.
not chasing those short-term trends. And the other big thing is those pesky fees,
Yeah.
the expense ratios.
Right.
You want to keep those as low as possible,
Okay.
ideally under 1%.
Right.
Otherwise, they'll eat into your returns over time.
Those fees can be sneaky.
They can.
It's like death by 1,000 cuts for your investment gains.
You got it. It's all about maximizing your returns, and keeping those fees in check is a big part of that.
Now, I know some folks are comfortable researching and picking their own investments,
Sure.
but for others,
Yeah,
it can feel overwhelming.
you can.
What about the role of financial advisors in this whole process?
I'd say that for many people, especially those new to investing or those with complex financial situations,
Right.
a good financial advisor can be worth their weight in gold.
Okay, so let's say someone decides to seek professional help. How do they find an advisor who's truly looking out for their best interests?
Look for an advisor who acts as a fiduciary.
Okay.
This means they're legally obligated to put your interests first, ahead of their own commissions or any incentives from investment companies.
So it's like having a financial advocate on your side,
Yep.
someone who's in your corner
Yeah.
and fighting for your financial well-being.
Exactly.
Yeah.
They can help you create a personalized investment plan, guide you through those tricky decisions, and provide ongoing support as your needs evolve.
Okay, so we've talked about choosing funds, fees, and the role of advisors. But there's another piece of the puzzle that we need to address: diversification. It's a word that gets thrown around a lot in the investment world.
Yeah, it does.
But what does it actually mean,
Yeah.
and why is it so important?
Diversification is all about not putting all your eggs in one basket.
Okay.
It's about spreading your investments across different asset classes, sectors, and geographic regions to reduce your overall risk.
Okay.
Think of it like this. If you invest all your money in a single stock and that company goes belly up,
Oh, yeah.
you lose everything.
Right.
But if you spread your investments across multiple stocks, bonds, real estate, and maybe even some international holdings,
Right.
you're less vulnerable to any single investment going sour.
So it's about creating a safety net for your portfolio, spreading the risk, and smoothing out those bumps in the road.
That's a great way to put it. Diversification is one of the most powerful tools for managing risk and protecting your hard-earned money.
Now, I know Ramsey focuses primarily on growth stock mutual funds,
Yeah,
but does he acknowledge the importance of diversification?
he does. While he's a firm believer in the growth potential of stocks, he also recommends diversifying across different types of growth funds, like growth and income, aggressive growth, and international, as we discussed earlier.
Right.
This allocation helps spread your risk across different sectors and economies,
Okay.
ensuring you're not overly exposed to any single area.
So it's like creating a balanced ecosystem within your portfolio with different types of investments playing different roles and supporting each other.
Exactly. It's about finding that sweet spot between maximizing growth potential and minimizing risk.
All right, I think we've covered just about everything there is to know about Dave Ramsey's Baby Step 4.
I think so.
We've explored the rationale behind investing 15%,
Yeah.
unpacked the different investment vehicles, delved into the nitty-gritty of choosing funds,
Right.
and even addressed the importance of diversification and professional guidance.
Yeah.
Before we wrap up this epic deep dive,
Okay.
let's leave our listeners with some key takeaways
Okay.
and actionable steps they can take to start their own retirement investing journey.
Sounds good.
First and foremost, remember that investing is a marathon, not a sprint.
It is.
Don't get discouraged if you can't invest the full 15% right away.
Right.
Start small, be consistent, and gradually increase your contributions over time.
Got it.
And remember the power of automation. Set it and forget it, knowing that your money is steadily working for you in the background.
Absolutely. And don't underestimate the importance of knowledge and education.
Yeah.
The more you understand about investing, the more confident you'll feel in making informed decisions.
Right.
There are countless resources available, so take advantage of them.
And don't be afraid to seek professional guidance.
Point.
A good financial advisor can be a valuable asset,
Yeah,
helping you create a personalized plan and navigate the complexities of the market.
definitely.
Finally, remember that investing is not just about numbers and spreadsheets.
No, it's not.
It's also about mindset and emotions.
Absolutely.
Cultivate a long-term perspective.
Yeah.
Stay focused on your goals.
Right.
And don't let short-term market fluctuations derail your progress.
Good advice.
This has been an incredible journey into the world of retirement investing.
It really has.
We've covered a lot of ground, but the most important step is the one you take today.
That's true.
Start small, be consistent, and watch your financial future grow.
Exactly. It's time to take control of your financial destiny and create a future where you have choices, freedom, and peace of mind.
That's a wrap on our deep dive into Dave Ramsey's Baby Step 4.
Thanks for joining us.
We hope you found this episode insightful,
Yeah.
empowering, and maybe even a little bit inspiring.
Absolutely.
Until next time,
Yeah.
happy investing.
Happy investing.